We've got trader John Brady of MF Global standing by live at the Chicago Mercantile Exchange. Also with us is Jeff Mortimer, the Chief Investment Officer of Charles Schwab Investment Management. And Dan, let me kick things off with you. So John, excuse me. We've got the S&P up 3 days in a row. You're seeing some support here for the trade?
A little bit, Carol. You know, the market's very, very quiet here as we kind of go into the close, and we'll see what tomorrow's trade brings. But there's been a cessation of fears emanating from Europe the earlier part of this week. Technically, S&Ps are going to settle above 1101.10, which was the month high before today's trade. So technically, the market trades pretty well. You have to hand it to the market and the fact that fears have seceded from both Fed policy as well as from European concerns. So the market trades pretty well in here as we go into our close.
Do you feel like, though, just give it a couple of days, give it another week, though, John, and it'll be back, those fears?
It could be, Carol, but I think the risk is that many investors get caught off sides by having their attention focused on Europe when, in fact, the risks may be on the other side of the world in China. You know, China has been closed for the most part of this week due to holiday. However, we still think that there are odds that the Chinese will continue to increase interest rates in order to slow their economy down. Friday afternoons at 6 p.m. Eastern Time will grow in importance to the markets because that's when the Chinese central bank tends to make announcements. So investors are going to probably have to change their ways a little bit here in the coming weeks and sort of keep a close eye on things come Fridays at 6 o'clock p.m.
Let's go to Jeff Mortimer from Charles Schwab. And Jeff, let me ask you, concerns about China, we've seen them weigh on the market heavily. Concerns about Greece, though, have roiled the markets for 3 or 4 weeks now. What do you think is more important? I mean, are the markets going to continue their focus on sovereign debt problems, or does Chinese growth become a bigger issue?
I mean, the market has tended to look at bad news and to reflect in a downward motion in the near term. However, you've got, Dubai issues, Greece, China. What I continue to focus on, however, is how resilient this market has been, that it might go down 200, 300, 400, 500 points, but then quickly, as we've seen on days like today, rally back. That how much of it is already discounted in the markets is what I also look for.
And Jeff, you think we're actually in the beginning of a bull move, correct?
I do. This market had made a textbook low on March 9th, in my opinion, in Schwab Fund's opinion. And it has played out, again, you get an aggressive move off the low. You get a rally of some 50% or so. Bull markets get 50% of their return in the first year of life, so this one's been consistent with that. And then what happens is markets slow down. Things trip them up, but they go through corrective phases. It doesn't tend to throw the market off. And as the economy continues to expand and grow, unemployment comes down, maybe slowly, but markets kind of push higher into that wall of worry phase. So I think that's where we are. But I'm talking over a number of years, not necessarily months or quarters, but over a number of years.
So, John, we've had a lot of economic news. I'm just curious, you guys on the floor there, are you feeling like that the reports are continuing to show that, yes, indeed, the recovery is on track here?
The reports have been mixed this week, Carol. Certainly the Philadelphia Fed report today, the subcomponents of that report were relatively strong. The new orders subcomponent index, for example, was exceptionally strong. Jobless claims went the wrong way. You would have thought with the snowstorms out east last week that jobless claims and people filing for jobless claims would have been lower as they stayed at home and avoided the snowstorm. Instead, they went the wrong way. So there continues to be a little, I would say, mixed signals on the economy. The NAHB index earlier this week suggested that any sort of bounce in the housing market appears to be rather limited. Now, the floor did get a buzz today, and traders were a buzz today about halfway through the trading session when Treasury futures, the March Treasury futures complex, that 10-year note, traded very, very heavy volume at the 117.16, 117.15 level. And the thought that there was a large liquidation trade going on, not knowing the specific name of the trader, it certainly felt as if there was a large liquidation trade taking place. We don't know if it's in relation to the Fed and the ending of their QE or perhaps a reallocation of assets by China. But there was a heavy trade on the back end of the curve, and back end interest rates are going to play a role in all markets, we think, between now and the end of the year.
Jeff, let me bring you back into this, because what's your outlook for interest rates at this point?
I think that there will be upward pressure on rates. I think both in the short end, we'll have to wait to see how the long end reacts to both, dollar strength and weakness, economic strength and weakness, all those issues that have been mentioned, whether the Fed pulls out of purchase programs, what happens going to happen with mortgages as well. So I think there's a lot of variables. But to me, the path of least resistance seems to be over the near and intermediate term, at least, slightly higher. I worry, too, that the retail investor, the individual investor, has moved a lot of monies out the curve, out into bonds, looking for some yield. And I worry that they will be surprised, potentially, at what rising rates will do to their principal. They still may make their income. Their income may be safe, again, especially in treasuries and whatnot, and even in high-grade corporates. But again, the principal deterioration that they may suffer as rates rise is also a concern of mine, and that may lead to rates going up more than they might, as those investors may be quick to sell.
Brennan just breaking down his report, talking about kind of the moves we've seen, and we've seen a correction and what happens. I mean, is that a good argument, John, in your view, that because we've seen a pullback, that we should see some upward momentum at this point?
I think that the argument is sound. Where my question would be specifically on the strength of the financials moving forward, Carol. With the legislative agenda currently in Washington, D.C., with bank lending portfolios collapsing at a rapid pace, and with sort of a move to perhaps curb back on bank proprietary trading, it remains rather challenging to think where bank revenues and incomes are going to grow in such an environment. So if you take the financials away from that historical piece, it just seems rather challenging to me to see exactly where the upside growth in equities is going to come from.
Jeff, what do you think? I mean, I know you think it's key to consider history when you're looking to the future here. Do you think investors are doing that, should be doing it more of it?
I think history is always your guide. I love Mark Twain's quote, it doesn't repeat itself, but it often rhymes. And we have to understand, what it does teach us, and understand things are always different, but eerily similar. I liked your prior guest comment on the snapback after the corrections that have taken place from March 9th. I think it's evident probably that those snapbacks were probably most strong early on from the bull market, from the bear market bottom, and then will probably dissipate some of their strength. So I don't know if I buy the 15% move higher, but I do buy that the market may, if we talk months from now, maybe again testing those old highs as it pushes higher. Into the bull phase, as we said.
Guys, this is something we've talked about. We're talking about Simon Property and general growth, and we'll see how this plays out. But, I mean, we are seeing a lot of companies that have a lot of cash, and they're putting that to work, doing some deals. Jeff, I ask this a lot, but it is a good sign, a sign of a healthier market out there.
No question. I love when strong hands come in with hordes of cash and purchase. It, to me, is evident that there is value out there in the marketplace, and that if the stock price does not reflect it, then somebody else will come in and make it reflect that. So you're clearly seeing that take place nowadays. Well,
let me ask you, I noticed that you think we're looking at the beginning of a bull move here. When you say that, you mean beginning now, or do you mean beginning over the last 12 months? Because obviously we've had a pretty incredible move in the equity markets already.
Beginning March 9th of 2009 was when I think the bull phase began. Our research showed that you had reached the same valuation levels that you had in 1972, 73, and even after 1982. So, you're really into those very nice comparisons where if you were a long-term investor and began buying at those periods of time historically, it doesn't mean that it's straight up from here. That's not what I'm saying. There are healthy corrections that will take place. But I think you've got a move where the market is extremely skeptical. Investors are extremely skeptical, and that's a necessary ingredient as markets push higher, as news comes out, as things unfold that are just slightly better than people expect, and markets reflect that by moving up in price. And so I think that's the phase that we're in.
Again, we get these technology earnings, guys, and they do come in better than expected. I mean, John, technology, is that where you see kind of the gains going forward here?
I think so, Carol. I think that businesses may be a little bit more reluctant to hire, given the cost. So investments in new infrastructure probably certainly make sense for companies that do find themselves rather cash heavy. I would likewise suggest that given the weakness of the U.S. dollar over the course of the last 6 to 9 months, that computer exports and overseas sales have certainly benefited the bottom line of companies like Hewlett-Packard and Intel. So I think technology corporations are suffering sort of a wind or two winds at their at their back, both domestically in terms of fixed capital investment as well as overseas sales.
Jeff, let me ask you, in terms of technology, I mean, you have been saying that your investors are completely skeptical of the market move right now. They're underinvested in equities. When they do put money to work, is it technology? Is that where they want to be committed?
You know, I would push them more into even more broadly diversified exposure if that's where they want to start. But I think I would make sure that I have exposure to things like financials, which are 15% of the S&P 500. And my guess is that individuals are underinvested there. I also like materials. I like technology as well. But I like the beta exposure first, and then these other things to try to play tactically, that's fine too. But I would recommend to investors, again, equity exposure in and of itself is most important.
But financials are key. Why do you think they should focus on financials, aside from the fact that it's a big heavy weighting of the S&P? I mean, aren't you concerned about further shoes to drop here? Aren't you concerned about the valuations of the things that they've got on their balance sheets?
Again, in the study that was, I think his name was Brent, that he illustrated a bit earlier, talking about the rebounds were led by financials up some 32%. So when pullbacks happen like that, financials participate in the bull move that has come after. So I know, there are issues with commercial real estate. There are issues with debt. There are issues with proprietary trading and regulation and all those other things. Those are very well known, however, and market prices reflect that currently. What we have to decide as investors is the future going to play out better than that or worse than what is currently being discounted in the market? And I think the headline news keeps a lot of investors away from investments that they should be making, because you are getting valuation here. Goldman Sachs at $155, not $190. Okay. The Dow at 10,000, not 14. So there are values here, even though the headlines look a little murky.
Got it. All right. Hey, Jeff, thanks so much for joining us. Jeff Mortimer there from Charles Schwab. Also want to thank John Brady for joining us as well.